Okay, so we're here with James White. James is a general manager for banking at Total Expert, and he's agreed to talk to us some about the banking industry today. I'm excited for him to be here. My first question for you, James, is how can small banks and credit unions compete with the big guys?
Yeah, so that is a great question because one of the reasons why they struggle is just from a lack of scale and investment dollars. So first thing they have to do is be able to leverage some of the QSOs as an example in a credit union space where it's pulling together multiple investment dollars from multiple credit unions to be able to build the newer and updated technology that they all can leverage. That helps them. There's also third parties, consulting firms. Actually, I used to work for one by the name of Radden Financial, where we would help small or mid-sized banks and credit unions compete with the big guys. And that's developing strategies, being able to pull together to get market research as an example, so that you're not just using your gut for decisions, you're able to use analytics for decisions. But it's really all about scale. The big guys, that's the benefit. Everything from compliance cost, which continues to grow every day, IT costs, which continues to grow every day as well. That just puts such a burden on those mid-market banks and credit unions that they've got to be able to leverage scale in some ways. As well, oftentimes the executives at these mid-market institutions have grown up in those institutions that they became executives in. And so being able to get outside influences to help make decisions, develop strategies. My personal experience is they often struggle to execute the strategic plans that are created as well. And so being able to outsource and hold accountable your teams as you're beginning to develop those product strategies as an example and rolling out those new products or technologies.
So why would, I guess trust plays a major role, right? So why is it that I choose to bank with Bank A and not Bank B? Talk about that, attracting deposits.
Yeah, so very interesting question. We as individuals in business, as an example, we forget that we're consumers as well, and that the things that we do in our normal lives apply business-wise. So if you think of your healthy relationships that you have as an individual, they typically have three things in common. One, they're reliable, so that means they're consistent. Your healthiest relationships are consistent. Two, they're relatable, which means that you either have something in common with that relationship or you have the desire to have something in common, meaning that you've just recently joined a club together, you're learning something together, you're in a class together, as an example. And then the other is trust. And so that relationship has to feel like it has a middle ground, that it's not just one-sided. That's how you build trust, is making sure that you have the other individual feel like that there's something in it for them and in it for you. Well, those healthy relationships, that translates to consumers as well. So if you're a bank or a credit union and you want to build a relationship with your customer, you need to be reliable, you need to be relatable, and you need to be credible. And the way you did that historically was by building a branch in some local community. You went to church, to school with all of those folks. You offered them their very first loan, and once you gave them their first loan, then they just were so loyal to you over those years that they never left. Well, now that's just not the same. And so you don't go into the branches often. There's internet banks and all kinds of other things. There's just so much distraction and fragmentation out into the market. And so you've got to find ways to build those same characteristics. You still got to be reliable, relatable, and credible. I mean, that still has to exist. So the way you do that is by demographic. You figure out how you're going to meet that consumer where they're at. So some consumers want to be more tech heavy. Some still want that human interaction. It also has to do with product. Mortgages are a much more emotional product than, say, a credit card, as an example. Mortgages are still the American dream. You're still fulfilling the American dream for a family. Oftentimes, even though you may have like a Quicken Loans as an example, or Rocket Mortgage now, you may want it to be somewhat fully electronic. There still has to be some kind of interaction human-wise. And so what you do is determine what that balance is. And then once you have figured out that balance, a bank and a credit union has had an ocean of data available to them since really the mid-90s. They've been trying to normalize and understand data. And they've gotten fairly good at normalizing it, but never acting on it and converting it over to action. So a lot of institutions have spent a lot of money on data warehouses, on Azure or AWS Cloud, and, all these Snowflake and all these technologies. And then they create all this data, and then really all they do is generate reports off of it and maybe an extract for another vendor. They're not really acting on it. So what you've got to do is take action on some of that data and not overanalyze it. So just to give you an example, CDs right now are a very big deal in banking. So first off, most younger consumers have no idea what a CD is, even the ones that used to put in a radio. So why do you call it a CD? First off, name it something that's relatable. And then just small segments of information can help you communicate to those consumers in a real way. So think about this. So a boomer who has a CD that is 1.78% or something like that, that's coming up for renewal in a few months, is rate shopping. They are relying on that money for their retirement, and a 2% increase is a big deal. And so they're looking around. Well, there's a lot of traps out there for them. Mm-hmm. So if you really want to build trust and you really want to be relatable, communicate to those CD customers in a relatable way with pictures that relate to them, with grandkids or whatever, and do financial literacy around compounding and the difference in annual compound versus monthly compounding, and how just a shift in rate will not necessarily always shift the amount of income that you generate. Compounding is important because there's a lot of traps out there where it may say 5% interest, but it's an annual compound versus a monthly compound. And then what you do as you get a little bit closer, if you know their expiration date, you start communicating with them about easy renewal rates. If it will auto-renew to something that's very close to market, you can, most of the time they're going to renew with you just because it's easier. Mm-hmm. So they renew for a 3.78%. Maybe they can get 4.1 for Robinhood, but does it really matter to them? So it's just those small things. It's like take segments of data because statistically you can grow as much information as you want, but there is diminishing returns at some point. But you just want to start to act. But at the end of the day, the average financial consumer has about 5 to 6 financial relationships, and that doesn't even include like your Target app and your Starbucks app, and some of those things that are looser but still financial relationships. And so you want to gain mind share, and so the way you do that is being reliable, consistently communicating with them in a relatable way, and building trust, showing them that you care about them. It's not just in it for you. You're always going to have consumers that are going to jump to the latest, highest rate, like a Robinhood or example, or maybe a SoFi or an Ally, some of these internet banks that don't have as large of a cost structure as some of the big, more established banks. But they're essentially buying deposits right now. And at some point in time, their cost of funds will be too high. And it will be a problem for them. You can only afford to buy so many deposits.
So, it's banks have always had access to more information about our financial behavior than anyone. Why is it that banks have been so slow to use that data? They seem like they're far behind the retail stores and.
Yes, so that's a great point. So I have a couple of opinions on that. So first off, financial institutions, banks and credit unions have historically been hyper compliance and back office operation focused. And all of the processes were designed from the back office forward. and the user or customer experience was secondary. And they also would not look at creative ways to monetize different information. And so they're looking at just very traditional ways to make money, which is why you still have terms out there like CDs and money markets and even checking accounts, which a lot of people don't even know what a check is. You know? And so they haven't culturally shifted. And it's sad to say, but one of the best ways to shift culture is to shift people. And when we've had free money for so long, these institutions have grown every year just by opening their doors. I can't tell you how many banks and credit unions that I've been into probably that have just said things like, well, we're growing 300%, this year over year. And I'm like, well, what's your strategy? Well, we built one branch over here. I'm like, that's not really a strategy. So it just shows that, people were bringing it in. They didn't have to work as hard for it. Now, there are so many fintechs out there, B2B and B2C, so much investment dollars that have been fed into that they are bleeding deposits and loans, and it's death by 1,000 cuts. There's so many holes in them, that it's coming, and they don't know what to do. And now in a rising rate environment, you have to lean in. You're going to have to flex muscles that you haven't had. Let's say the cream's going to rise to the top, and those that don't will be acquired or merged with in credit union land.
So just to be clear, if I have a low interest rate environment, not paying very much on my deposits, have a booming economy, making lots of loans, so it's pretty easy to be a bank in that case, right?
It's very easy. What you really struggle is how to process them all. The reason why you see so many layoffs right now is because banks and credit unions were throwing people at the problem to try to process all of these loans. It was a volume issue. And now when it slows down, they didn't need as many people. It was just all about trying to handle volume.
So when rates start to go up, when an economy starts to slow down, things get tougher, it seems to me like and I want to talk about neobanks, that these neobanks are maybe a little more innovative. And since I don't have to go to that branch down the street anymore, will a few neobanks win and be the big guys, or not even neo, but just will a few of the big banks win and the little guys go away?
Yeah, so, I'll answer that question directly, but then I also think that there's kind of a subset to that question. So the neobanks, the challenger banks, like I don't know if you saw yesterday, Brex, one of the fintechs, ended up with $2 billion of the Silicon Valley Bank's deposit. They have a benefit of they aren't as rate sensitive because they have a diversified portfolio and they have multiple income streams that are completely outside of margin income. And so we can talk about that in a moment. But these big banks are going to win. The way you think about it from a deposits and a loans perspective is everything has to be essentially refinanced, both deposits and loans. They all have to be repriced. The whole portfolio over time is going to be repriced. So all those loans are going to be paid off, and they're going to get new loans at different rates. Deposits are all going to be taken out, and so this time, because the Fed has raised rates so quickly, this repricing or refinancing has just caused all this major disruption. And institutions that don't have diverse portfolios are going to struggle. Savings banks, keep an eye on savings banks. They are struggling right now because they're only mortgages and deposits primarily, or CDs and mortgages primarily. That's why Silicon Valley Bank, one of the reasons is they weren't diverse. But you get somebody like the big banks, like Bank of America as an example, they're extremely diverse. They have their hands in everything, from a portfolio perspective. So one lever starts slowing down, they just start pulling other levers. So they'll be fine. And then what'll happen is a lot of these institutions that have poor balance sheets will be gobbled up because the Fed will reach out to the banks of America of the world and say, hey, I need you to take on, these depositors and these. That's the same thing that happened in, 2009, 2010 is, all these big, medium-sized banks grew to be astronomically sized because all of the smaller institutions or ones with poor strategies started having to be gobbled up, and the Fed picks, and chooses who to gobble them up. I do think there'll be a lot of pressure on whether or not, because, are you too big to fail and all those things that occurred. That's probably a whole nother topic. The market will start to pressure, I think, the Fed and some of these big banks to not get too big because people still are,
Right.
kind of tainted.
I think we'll circle back to Silicon Valley at the end of this because it just happened today. So we'll speculate some. So I guess we can talk some about the buy now, pay later, the work today, get paid today. If I'm a bank, do I want to participate in that? How do I participate in that? What's your view? Do you think that's a good thing or a bad thing?
Yeah, so from a community bank and a credit union perspective, we'll talk about that first. Community banks and credit unions, their value proposition is either to their membership or to their local community. So in my view, it's their responsibility to keep their customers or members financially healthy. I mean, it's their responsibility. And that's the reason why they should sell their products and services and feel comfortable selling them to their customers or members, is because it's benefiting them. So in order to do that, that means buy now, pay later is not what they should be participating in, because a consumer can get in so much trouble quickly there. And the big benefit to buy now, pay later is to the merchant. The merchant is selling a lot more product than they would have historically. So a lot of these buy now, pay later providers are actually being funded by the merchants themselves. But there are products and services that they should be offering, and technology that they should be offering, that will spin out of these buy now, pay later. So the benefit, there's a lot of benefits to the consumer for buy now, pay later, but one of the bigger benefits is the flexibility and being able to essentially secure a loan in just a few moments. And other providers have been able to create that as well. Think about the Apple credit card. While we're sitting here, we could apply and get an Apple credit card in just a few moments. And Apple's not taking on much more risk than your local financial institution. But the thing is, financial institutions are so ingrained in all of their compliance and processes that they don't think about the customer experience. So the buy now, pay later phenomenon is going to shift to where it continues to cause them to have to focus on that customer experience, being able to make a financial decision quickly, and not have to go into a branch and sit through 2 hours to get an auto loan. That's the future. The buy now, pay later, there's a balance though. You've got to have the balance of making the user experience good, but also not letting them get in trouble where they're just buying everything that they possibly can. You can't regulate, you can't adult for people, but you've got to be able to make it to where they can't get into so much trouble so easily from a community bank and credit union perspective. So creating technology like Bank of America has already done, where you can swipe your debit card on a transaction and after the fact, within their mobile app, switch that over to a loan and carve that over to a unsecured loan. That's a much more healthy way. Now you're not standing in front of the cashier going, man, I really do want this Louis Vuitton purse.
Right.
Yeah, and the emotion tied to that. You've got home and you're like, now should I take it back? Or if you still want it, now you can convert it over. Those are, I think, a lot more of a healthy way to do that. And I think you're starting to see a lot of the buy now, pay later struggle as well because of that. Also because of Apple saying that they're going to go into buy now, pay later. And they will not be tied to a merchant like some of these others are. Where you'll be able to essentially use them for anything. And what they're trying to do is what a lot of institutions and fintechs are trying to do is get complete control over that virtual wallet. you're starting to see banks and credit unions create their own virtual wallets to try to get you to use theirs. But really, whoever controls that virtual wallet is the future. So, and the reason why that is because there's something called PFI status, primary financial institution status. And that has historically been how banks and credit unions measured themselves from a relationship perspective. Basically, presence of a direct deposit, presence of an active debit card. Well, PFI status isn't as important anymore because it's so fragmented from a relationship perspective, and transaction behavior has become so important, both from an analytics perspective, but also from an income perspective. Your interchange income, swiping that card. Last year was the first year that non-interest income was equal to interest income in banks and credit unions. And so that gets you away from some of these issues, liquidity issues and things like that. Well, you start to control that virtual wallet, which means you're putting in all of the cards that you have in that virtual wallet. And so now you're not just seeing the transaction behavior of one account, you're seeing all of it. And now you can really monetize all of that data, which is back to what I was talking about a moment ago with challenger banks and neobanks and fintechs. They're able to monetize things in a creative way that helps them to go after markets that banks and credit unions haven't historically gone after.
So two questions. One, what's your good definition of a virtual wallet? And then talk about how they're monetizing. But
Yeah.
when you say virtual wallet, exactly what are we talking about?
Yeah, so a virtual wallet is where you actually put in your card information and account information for all of your financial relationships. And then you're able to use that virtual wallet to pay for things online, kind of like a PayPal or something like that. PayPal's have a virtual wallet. Or on your phone, where you use Apple Pay, but you're able to choose all those different financial relationships as the funding mechanism of what you're paying for. So that it will eventually get to where maybe cards go away. You're not swiping a card, you're tapping your phone or your watch, and you're not just doing that for just the one card that you have in there. Your full financial relationship is in there. And that's actually what Elon Musk is trying to do with Twitter. He wants to get to the super app that would have everything, your virtual wallet, all your cards and account information, all your social media, everything all in one overarching application. And so, yes, sir.
Yeah, that's
Yeah.
really interesting. So one thing I was thinking related to this, what we've talked about, all of this is financial literacy, or I guess the lack of financial literacy is a huge topic. And it seems like it's a mechanism, it's something banks should actually be involved in helping their customers understand how to spend their money, how to save their money. Because I guess if we're back like to the rapid buy, the basic idea, the merchants are the ones that are benefiting, not the individual, not the consumer. Mm-hmm. And if banks can help them make wiser decisions, manage their money better, it does seem like that is a plus for the banks.
Oh yeah, it's a plus for the banks, it's a plus for the economy, it's a
Right,
plus for the country.
right.
Yeah, so financial literacy is becoming a major thing in banking. So so I've spent 20 years helping community banks and credit unions grow. And so historically, a bank and a credit union both won business on a couple of things. It was either price, it was either service, or it was relationship, and so now financial literacy, I believe, is going to be that fourth pillar. And so I actually could even see that financial health becoming a scoring model that is factored into credit decisions, where it's not only your credit score, it's your financial health score.
Mm-hmm. It seems to me as a consumer, it's so complicated because there's so many choices. So if there's just one or two choices, life is simple. Mm-hmm. May not be as good, but it's simple. And now if I have all these different choices, doing it all a different way, if somebody can be the one that says, look, James, you're making a mistake here, you shouldn't be doing this, you should be doing that, I think that person would have a lot of value to me. And that goes back to that trust relationship, right? Mm-hmm. If the super app, if it's Twitter or Apple or whoever, is making me financially healthy, I'm going to trust them and not someone else.
So yeah, absolutely. Well, and the thing about it is though, so when I go into community banks or credit unions and I talk to them about financial health, most of them will tell you that they're doing financial health. And so what I ask is the hard question. So are you doing it to check a box off for your board, or are you doing it to actually increase the financial health of your customers or members? Because it's easy to create a blog on your website that it just has random articles about topics. That's completely different than, as I was talking about earlier with CDs and communicating to your customers in a real meaningful way about financial health, about a topic that you know is relatable to them. It's the same thing with buy now, pay later. A bank or credit union can see those transactions hitting their account. They know that they're paying a buy now, pay later. They could offer them a credit refinance, whether it be a HELOC or a credit card. They could offer them education, debt consolidation. They can start to be proactive around those types of things. Just by that's also some of the power of that transaction behavior. You can see accounts elsewhere because they're paying a Chase credit card or a buy now, pay later, or whatever.
You're almost like my coach,
Yeah.
which I really need. I know what to do, but I'm having to go to physical therapy for my back because I'm not doing the proper things to take care of it. I need that coach to help me out.
Yes.
So let's talk some about banking as a service and so I want you to just define, we've talked about neobanks, but you say neobank, challenger bank, banking as a service. Is Pluto a planet? So is there somebody that says, this is what those terms actually mean? Or is it just like the language has developed? So in your view, what are those things? Banking as a service, neobank, challenger bank.
Yeah, so first off, one of the things that I'm not a big fan of is buzzwords. I feel like I'm a very literal person, and if you look in the banking industry, there's waves of buzzwords. And all the ones you just mentioned were buzzwords. AI is the big buzzword now. Predictive analytics was the buzzword a couple of years ago. Customer journeys, the buzzword. And people pick these buzzwords up and then they mean different things to different people. And that's also how they market to you and confuse you sometimes. Like people use the term engagement all of the time. Well, what does engagement really mean, as an example? So anyway, banking as a service has become popular because a lot of fintechs have been trying to go after consumers with financial products. But in order to do that, especially if you want them to be insured, you need to have a banking charter. Well, a lot of fintechs, I think it actually started with Walmart, trying to get their own bank, went to the Fed trying to get these charters, and the Fed started pushing back and was like, no, we're not going to let all of these companies have charters. And so some banks have started essentially leasing out their charter. You're paying them a percentage of your income or a monthly fee, and they're taking on a lot of your risk, maybe not all of your risk, but a lot of your risk associated. And that's really what banking as a service does. Is you're essentially there's something called a core platform. Every bank has it's like the main operating system for the bank. It's what transactions are processed through and stored, and they're all fairly old. There's a few of them that are newer, but what you're doing then is all that fintech. You're offering banking as a service, which is your charter essentially leased, and you're going to process their transactions for them. So they can have all that cool front end technology, but you're going to hold the transactions for them so that, say, the Fed can insure them, as an example. And there are other benefits too. But what I have seen is there are big banks like JP Morgan who has leased their charter to Apple, or there are mid-market institutions that have struggled financially for other reasons and have started this whole leasing their charter as banking as a service. And that's really what it is. A neobank or a challenger bank is an institution that has gotten a charter themselves, typically. But they have created So what we used to call those is de novo banks. Have you ever heard the term de novo?
Yes.
Yeah. So de novo was you're starting a new bank. They used to create them all the time back in the early 2000s, but then
Yeah, that's real difficult to start a bank.
yeah, very difficult. But in the early days, it wasn't. You know, if we're wealthy, the three of us are wealthy, we could pull our money together and go to the Fed, and we create our own little family bank. And but then it started becoming more and more difficult. Neobanks and challenger banks have started with new business models, and a lot of times niche business models, but they do have a charter. Now, oftentimes because of their niche, they aren't federally insured because, say, their niche may be that they're taking into too large a deposit dollars to be federally insured. But one of my favorite neobanks is called Nubank, Nubanc. And what Nubank has done, which I think is pretty amazing, is they are massive in South America. And they're starting to try to get into the U.S. And banks and credit unions have always said that they want to get to the underbanked or the non-banked consumer. But when they say, it's easy to say that emotionally, but those are also not profitable consumers. And so that's the reason why they haven't cracked that code, is because taking on somebody who lives paycheck to paycheck and you're just not making any money off of them, you can't lend money to them. And so that's why that whole underserved market exists. Well, what Nubank has done is gone after that market exclusively. But the way they did that is they said, let's find ways to monetize the data or monetize in different ways than just taking in deposits and trying to loan them out and make money that way. So what they did was kind of like use Google, you know, as an example. They, how much would governments pay to know the transaction behavioral data of the non-banked and underserved banking market, you know, as an example? No telling, you know. And so, yeah, legally you can't say James is non-banked and what does James do, but you can roll James up and say this is what everybody that looks and acts like James does. And so now you take all of that data, you aggregate it, you create personas and segments and segmentation, and you're able to sell all of that information to big data aggregators like Axiom or Nielsen or Claritas, Equifax. You're also able to sell it to governments. And if you look at Nubank, they're growing like crazy because of that. And that's just an example. So all of these newer companies that are younger demographics, they think about things in a new way. They start out with, how am I going to monetize my company? How am I going to make money? And then I'll back into the products and services. Whereas the older demographic bankers like, okay, well, I got a CD rate of 2%. Everybody should just come running to me to get my 2% CD.
Right. I'll pay the deposit 2%.
I'll loan it out for
loan it,
6%.
6%.
Yeah.
And clock out at 3 o'clock and I'm done.
Yeah, exactly. And so that's just an old way of thinking. And I know it's been a shift for me as well. So I come from, you know, the more traditional companies, and then I recently moved over to a fintech. And some of the things that we're doing is somewhat mind-blowing. You know, I have to think about, you know, we're no longer using relational databases. We're using event streaming, which is a complete paradigm shift. You know, it's just like...
So tell me what those are.
Yeah, so a relational database is what most technologies have used historically, which is I create a SQL database. I have one table that holds this data file, another table that holds this data file, and they're related in some way. So it may be James White and his address and telephone number is one table, and then all of the products that he has with the bank is in one table, the pricing for another, and it relates in so that you can query those. Well, that has a ton of benefits, but when you start to handle large volumes of data, you can't use a relational database. It just doesn't respond fast enough. So like in a SaaS platform, which we are, and a multi-tenant, So as an example, we have somewhere right around 60,000 users logged into our platform every day. And so when you start thinking about those kinds of volumes of data and querying, and it's SaaS-based, so it's web-based, you can't have slowdowns. And so some of this newer technology that, say, Twitter and Facebook and some of these use, it's called event streaming. And what event streaming is it's like a natural data flow that's just flowing in, and you're reaching up and just grabbing the bits of data that you need at one point in time. And you may even put them in a temporary relational database that you use for just a moment of time to do a calculation or something, but then you're deleting it. And that doesn't impact all of your other users and customers. And so if you think about transaction data, one of the reasons why people and banks haven't used transaction data for a long time is because the sheer volume of data is astronomical. You think every time you swipe your debit card equals one row in a data file, and however many customers, how many people in your family that are doing it, and customers of the bank, it just grows and grows and grows. So storing that data, analyzing that data, it becomes very large, and older technology couldn't really handle it well. Well, now all this new stuff where they're streaming, and it's pretty mind-blowing for an older gentleman like myself,
Exactly.
But that's, that kind of stuff is the future. But candidly, us three aren't going to think of that. That's a new, younger, more innovative thinker that's going to come up with these types of things. And so that's the benefit that fintechs have, is getting this new innovation and then leveraging an old man like me with all of the banking background to tell them, the nuances of the industry, and then being able to roll it out to these financial institutions is really cool. So I tell people, historically we would lay out at my old company, we would lay out a roadmap for our software. There would be quarterly releases that we may or may not hit, on timeline, and we may know 2 years worth of roadmap ahead of time. Well, now we roll out code monthly. The customers never even see it because it's all SaaS. We just put it out, just deploy it, and we can change roadmaps in days, weeks. If I have a customer asking me for a 12-month roadmap, I could give them a high-level structure, but something cool may come up in 6 months that we don't even know exists right now.
Right.
That we're writing code for.
So you had mentioned in a previous conversation that I think you're at a different firm and you had a project that you wanted to get done, and it was so difficult to do, and now you're at a fintech and we'll do that next week.
Yep. So that was a whole budgeting project that I wanted to be able to do, where you could feed in data to automatically generate ROI and output it into essentially a budget requirements document, so that when you go to present your budget, you have all of this framework. Because at least in the software business, one of the issues you have is the telephone game principle. Essentially, you sell your product and convince the customer to buy it, and then now they've got to take it to get it approved to the board. Well, you don't get to participate in that conversation, and you're only as good as how well equipped that individual is and how talented that individual is at selling it on your behalf. And so what you want to be able to do is have something with ease that you can output essentially a package that individual could take and say, here's the business case, here's the use cases, here's the ROI. Basically make it where they can't say no. And I tried for 3 years to get that done at my last company. And I just mentioned it on a whim, and we had it done in about 2 weeks.
So traditionally, banks are the most regulated industry in the economy. Almost everything we're talking about here just flies in the face of regulation or challenges regulation. So moving forward, that seems to be the biggest conflict that's going to continue. And so, do regulators need to change? Do the banks need to, these fintechs and startups, do they need to fall in line? I mean, what is that? That future seems to be highly uncertain, and since banking is such a huge part of the economy, that seems to be a very interesting topic going forward.
Yeah, so I agree, and I personally believe it's going to land in the middle.
Okay.
Every time you see the pendulum start to swing one way, I feel like something happens. Like just a couple of years ago, I think it was swinging towards deregulation, and then FTX happens. And then as soon as FTX happens, then it starts
Right.
swinging back. And so the same thing with Silicon Valley Bank. So what will end up happening is it has to be somewhere in the middle. Right now, regulatory environment impacts banks and credit unions tremendously. So at my last company, we helped institutions grow. And what we enjoyed was when there was a government shift. We didn't care which one it is, shift from Democrat to Republican or Republican to Democrat, just whichever one. But there was different strategies that they needed us for. But if it stayed too long in one, then we run out of things to talk about.
So your official political party is the other guy.
Yeah, exactly. Just whatever the other guy is. But it will have to. Consumers will force regulations to back off to some extent, I believe. But they also force there to be creative ways where you still are focused on the consumer and the consumer experience, and then handling the regulatory requirements in the background, and leveraging technology to handle some of those regulatory, to make 12 copies of this one form. You don't need to do that. But it's still going to take time. I bet you we're 10 years probably. From it ended up somewhere in the middle. We still, as a fintech, we'll go through the whole sales process, and then I would say half of the vendor due diligence process, which can last about a month, is all just compliance. Just making sure that we're SOC 2, and then there's RESPA for the mortgage side. There's all these things that we have to do. We always pass, but it would also be great if you could go to these regulatory environments and just get essentially your TSA pre-check, and
Right.
you just check the box, and here's my TSA pre-check number.
It's a good idea. So we're starting to run short on time. I want to go back to Silicon Valley Bank. Silicon Valley Bank, we know is going into receivership. All we know at this point as of filming is that the FDIC is taking it over. State regulators in California have worked with the FDIC. I know that only 2.7% of their deposits were insured. They do a lot of work with fintechs, so they're funding a lot of fintechs. So James, I guess speculate, what are your thoughts?
Yeah, so this relates a lot to what I was just talking about earlier about having too simplified of a balance sheet and a strategy. You've got to have a diverse portfolio. And so what has essentially happened, at least from what I can tell, is the institution was flooded with deposits. And so one thing that a lot of people don't realize is there are costs associated with those deposits. So if you deposit $100 in a checking account, even if it just sits there, it costs the bank money for the system that is holding it and processing it, electricity for it to run, statements to be generated and emailed to you or printed, having the networks in place for your debit card to be active even though you don't swipe it.
And that's why the underbanked are not profitable.
Exactly. And so it costs about $100 per checking account to keep a checking account active.
Per year?
Per year, rough numbers. And so if they aren't generating any kind of income, then that can add up, pretty dramatically. And so what would happen is these banks, when they were flooded with deposits, and they were also flooded with loans, but not enough loans to cover the deposits, they had to find ways to invest it. And so there's a number of different ways to invest deposit dollars. You can invest it in other companies, which is what a lot of banks do. Credit unions invest in CUSOs oftentimes.
What's a CUSO?
A CUSO is an organization that is owned by multiple credit unions. and that could be a fintech. It could be direct to consumer. But what QSO is limited by is the only consumers that they can service is either other credit unions or the consumers in which a credit union has been segmented and allowed to service through the owners of that segmentation. But there's a lot of QSOs that have been created, and those are just ways to invest those dollars. You can loan money out to the Federal Home Loan Bank and essentially loan it to other banks. But those are some of the ways. But one way is to buy treasury and buy bonds. And what ended up happening is Silicon Valley Bank bought a bunch of bonds. And there's a lot of banks out there, by the way, that have done this, that bought a bunch of bonds. And then once the Fed started jacking the rate up, so they own these bonds at 1.7% interest, as an example. Well, and they need to, bonds, first off, aren't highly liquid. You got to wait for them to term out. If you want that money now quicker, you've got to sell those bonds. Well, somebody's got to want to buy those bonds. Well, if you want to buy those bonds, why would you buy a 1.7% interest rate bond for full value when you can buy government bonds yourself for 4% right now? And so they end up having to buy or sell those at a surplus. And so they say if they bought $1 billion worth of bonds, I think it was actually more than that, billions of dollars worth of bonds, and now they've got to sell them. I think they were going to sell them at a $1.8 billion loss, I think is what I saw on one.
I think that's right.
Mm-hmm.
Yeah.
Yeah, which is insane. But what ended up happening was when they were going to do that because large dollar depositors wanted to get their money out. And maybe we should talk about this as well. Large dollar depositors weren't getting enough interest off of their deposits at Silicon Valley Bank, so they wanted to move it to a higher deposit rate environment to make more money. They start pulling out all these deposits. They can't get the cash to pay them. They're going to lose this money. The market finds out and dumps all their stock. Next thing you know, they're insolvent. And that could happen with a lot of other banks, especially savings banks. That could happen pretty easily.
So we think bank runs were a thing of the 30s. It's a movie, It's a Wonderful Life, because we have the FDIC, which was, I think, formed in 1933. Said bank runs are over. But if only 2.7% of deposits are insured, we're back to bank runs.
Yeah, exactly. Well, and the savings and loan crash as well in the 80s was a big deal as well.
That one I don't remember. I want to be on the record.
Okay.
I've studied it, but I was not aware at the time.
Yeah, it's like 2,600 savings and loan banks closed in the 80s.
Right.
And so basically, one of the things that we have as a risk as an economy right now is the lack of financial literacy in people that see the headlines without knowing what it all means. If we start having a run on banks in some way, form or fashion, that's going to send us into a recession. Or we could have things like large dollar consumers that have CDs that all of a sudden they start pulling their money out to go somewhere. And you could end up having big liquidity issues. You could have just banks that really have trouble. But you've got to have a diverse portfolio, and they just don't. A lot of them don't. Some of them do, but it's a real risk right now because, as we were talking about earlier, banks and credit unions haven't done a good job of finding ways to create deposit strategies that stand out from others, stand out from a Robinhood, as an example. Why should you want to keep your money in whatever bank you use versus Robinhood?
Because years ago, if I wanted to move money out of my bank, go get in the car, go down to the branch, get the money out, and then where do I put it? I can remember going to a Merrill Lynch branch in a small town, Alabama, as a high school project, and we watched the ticker. If you wanted to invest, you had to go to Hot Tip Taylor, as what his nickname was, and you had to go through him. Now, app on the phone, Robinhood.
Yep.
So why should I leave money sitting in a bank account on deposit there if I can just go to these fintechs? And that kind of brings me back to, like, originally I said, well, I think maybe only the big banks will win because the innovators are going to win. The old, stereotypical old guy running the credit union is not keeping up. They're going to go away. But will the regulators want to have a few big banks Well, the regulators want to have thousands of little banks.
Yeah, the regulators want thousands of little banks because it's just healthier overall. The thousands hopefully aren't going to close down, whereas if one, too big to fail, closes. I mean, Silicon Valley Bank is, I think it's like a $119 billion bank. That's a big
It
bank.
was the second biggest bank failure in U.S.
Yeah,
history.
Yeah. And so that will make regulators pause on letting banks grow to too big. But, deposit rates is a very interesting thing. So first off, there's different types of depositors. There's your rate shoppers, that are constantly looking for high rates. There's what I call sleepy depositors, which are they just put their money in their bank and it just sits there. And so what you got to do is try to keep your rate shoppers without waking up your sleepy depositors. And it's a whole balancing act because I'm sure you guys have taught about cost of funds, and
Right.
you got to manage that whole cost of funds, and so you're constantly shifting, day to day on how to manage that. And what people think about when we talk about this whole deposit race is they forget the concept of commercial depositors. So commercial depositors lead the way on the shifting. And so that's what happened with Silicon Valley Bank is, so the shifting of retail deposits has just started to occur, whereas the commercial deposit shift has been going on for 6-8 months, and it's because a few basis points makes a big difference to $1 billion, more than
Right.
it does, my $2,000.
Right.
And so they're a lot more rate sensitive, these commercial depositors. And so that's why they're moving and shifting, so quickly. And they also aren't, as you mentioned, they aren't insured. And so they're trying to find the lowest risk, highest rate of return possible. And that is also why I believe that you see a lot of what I would have considered unnatural investments over the past few years because rates were so low. People were just trying to figure out a way to earn more money. So it's like, okay, I'm going to invest in all these fintechs, or I'm going to invest in crypto, or I'm going to invest in NFTs, or I'm going to invest
Invest in NFTs, I think you're using the wrong word.
Yeah, probably.
Maybe
I'm
not
gonna
invest.
Yeah, I'm going to purchase it.
Yeah.
Yeah. Well, but they would purchase NFTs hoping that they were going to sell them, right?
Right.
At a higher rate, and so they're just trying to generate these returns. The great thing I believe about the rising rate environment is after all of this refinance occurs, we'll have a lot healthier economy because now banks can manage both sides of the equation. When one's always zero, you're just trying to grow, and also people will have a lot safer, healthier vehicles to invest in. I remember as a kid, getting bonds from my grandparents, and then you get to cash them out. Well, when's the last time anybody outside of that was focused on finance cared about a bond?
Right.
Right.
So I do want to talk to Silicon Valley Bank did something that's a little not as well known, like with venture debt. So if I'm a startup company, and they do a lot in the fintech space. So I'm a young company, I don't want to sell equity because I'll dilute my shares, I want to have some debt. So banks like Silicon Valley Bank would come alongside and say, okay, we've looked at you, we think you're healthy, good investment, we're going to loan you this venture debt. But one of the covenants is you need to have a certain amount of cash or all your cash in my bank.
Mm-hmm.
So now that Silicon Valley Bank has failed, these startups, what happens to their money? It's not insured because it's over $250,000. What's going to happen to payroll? How's it going to spiral through the economy?
Yeah, no, that will absolutely spiral through the economy, and eventually they will get some of it back. They won't get 100% of it back, but the Fed will sell off all of the or liquidate everything and start giving the depositors their funds back. But they also will determine, if you and I both own startups and we both are out, our money, you get a percentage, I'm going to get a percentage, over time when we're figuring out what to do. We've already started to see the consolidation of fintech. So, there was like a fintech boom from an investment perspective, and you had a lot of followers versus leaders, where somebody created this fintech, which was successful, I'm going to create one just like it. We've already started to see some of that consolidation down because, what fintechs didn't think about, especially B2B fintechs, is how hard it is to get a brand in banking, and how hard it is to meet the regulatory requirements, and how hard it is to get mind share and convince a lot of these institutions to take a bet on you.
So you said previously also the word mind share and not market share.
Yes.
So tell me why you're being precise in your language there.
Yeah, so mind share means that, I mean, everyone knows what mind share, but what it really is that when you have so many fintechs that were coming into the banking industry and everybody's trying to get their brand out there, and they're trying to get these like the big three to partner with them, and they're trying to get market share. What they're trying to do is spend all these marketing dollars and spend all this relationship time trying to stand out, trying to get the banks to think about you as a company, and then also once they recognize that you exist and think about you, then think that you have value, so that then you can actually start to sell to them. But so as an example, that's really one of the reasons why I'm at my organization today, is because of my experience is, and we're helping to gain credibility out into the marketplace. So I write a lot of thought leadership and do a lot of webinars and podcasts and things. And it's just trying to get our name out there, and not just from a brand recognition perspective, not just where they know who Total Expert is, but know why Total Expert matters. And so, and why they should invest in us, or by purchasing our products. But when I was at my previous organization, we had a strong brand recognition within banking, especially in credit unions. And so I would have fintechs reach out almost daily trying to partner with me, just so that they could leverage my brand to try to go after that market. FIS, Fiserv, Jack Henry, they get reached out to 100 times a day trying to partner with them, and for that very reason.
So I'm thinking, as we're straying a little bit from SVB, but as a smaller bank, there are all these great opportunities out there to partner with fintechs. But have limited staff, a limited ability. Rich, is yours fintech good? Is it James? Which one should I go with? I don't know. Maybe I'm just like, that's too much.
For sure. Yeah, and it's not just the companies, it's the topics. Well, should I be focused on account creation right now, or should I be focused on omni-channel integrations, or should I be focused on customer journeys, which is a big thing, or member journeys and what the experience is, or personalization? And so helping them focus in on a topic and then companies is very difficult. There's actually a lot of consulting firms now that have popped up that are out there to help these banks and credit unions navigate this process.
So as we're wrapping up here, you said omni-channel. Could you talk just for a couple of minutes about what that means?
Sure.
How banks are...
Yeah, so omni-channel is also a buzzword that can mean a lot of different things. But what it really means is having the same experience no matter where you're attempting to interact with that bank or credit union. So as an example, if I go to my mobile phone, it should look and feel from a brand perspective and from a tech perspective much more in line with if I'm go into online banking, or if even the sound and interaction should be for telephone banking and ATMs, and if I go to open a loan online versus even if I go to inside the branch and I open a loan, all those different channels have to look and feel and interact the same. Also, I need to be able to start a process in one channel and finish it in another. So maybe I start to apply for a loan online, and then it gets too complicated. And so I go into the branch and say, I've started my loan online. They need to be able to pull it up and interact with me to help answer those questions. And so that's something that somewhere right around 5 years maybe or so, institutions have been trying to solve. And it's very difficult because oftentimes they use different vendors for all of those different channel interactions. And so, and they can be different technologies. One could be a technology that was created in the 90s. One could be a recent technology. And Online and mobile banking, even though it seems simple, can oftentimes be very different. It could be a web optimized mobile experience versus its own app, as an example, that looks, older technology versus new, all those types of things. So it's really still about the customer member experience and being able to match these other industries, like what people have grown to expect from retail. I call it the Amazonification.
Right. You should be one touch.
So with just one touch, yeah. And people are willing to pay for convenience. Amazon proved that people are willing to pay for convenience.
So, Jonathan and I are teachers, and so our students are always asking us for advice on how do they break into the industry, what sort of skills do companies look for, personality traits. What kind of advice would you give to students who are looking to get into the financial area at all, into the industry?
Yeah, so first off, I would say that that students today are the future. We have to have a new wave of employees coming into the industry because there is a lot of boomers, and I'm right on the Gen X range, but there's a lot of us that are over 40 that are in the industry, and so there's a big push to get younger demographics. But you still have to think that what most employers are looking for is what I would call attitude and aptitude. So it's not as much about what you know, it's about your desire to learn and your ability to learn and pivot. There's a lot of great individuals out there that have a lot of experience, that are great leaders, that would love to mentor individuals, but that individual has to be open to being mentored and desire to be mentored and ask to be mentored. And then, having that drive to be successful, where, like, as an example, what I tell people is, I may not be smarter than you, but I promise you I'll outwork you. And that's why I've been successful. And I'm not asking for people to give up their lives, but I am asking for them to want to work to be successful. And that's what I see, not only among my company, but my peers. We're all looking for attitude and aptitude. That we may say it in different terms, but that's essentially it.
All right. Well, thanks, James. Appreciate the time.
Absolutely.
It was fantastic. And now let's go get some lunch.
Let's do it.